Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, let's just dive straight in. We're looking at one of the most compelling cases of equity decoupling I think we've seen all year. Howson Holdings Limited, NASDAQ ticker HXHX. The focus really has to be on the catastrophic volatility from Monday, December 22nd, 2025, the Monday event.
That specific day, it really does require a close look. We saw the stock surge from a previous close of around 35 cents to an intraday peak of $1.28. That's a nearly 300% gain, completely and utterly disconnected from the underlying business.
And the volume, the volume is where the story truly lies. It clocked, 321 million shares traded. Now, when you compare that to the estimated tradable float, which is only about 5.8 million shares, that means the float turned over roughly 55 times. 55, imagine the deed to every single share changing hands 55 times in a single day.
And that staggering turnover, that's our central conflict right there. Does this catastrophic volatility, does it fundamentally arise from the company's severe corporate and regulatory distress, signaling an inevitable financial collapse? Or is it, as you might argue, primarily a product of external market microstructure, algorithms, and just sentiment that renders the company's finances irrelevant?
I'm going to argue that the price action is almost entirely governed by technical market structure. HXHX has, by any reasonable definition, ceased to function as a traditional investment in a Chinese logistics business. It is a highly specialized trading vehicle operating purely on mechanical momentum.
And I maintain that the spectacular volatility we're seeing is merely an accelerated symptom of a deep existential financial fragility, and of course the mandatory regulatory action that fragility necessitates. The market isn't creating the instability, it's just reacting violently to an unavoidable reality. The price is crashing long-term because the company is fundamentally broken.
My position is really rooted in that extreme trading data from Monday, that 55 times float rotation. That's the singular critical metric. This volume represents a complete systemic flush. It overrides all historical technical resistance and, frankly, it ignores any rational valuation of, hauling frozen food in Ningbo. The market participants here are measuring volatility, not intrinsic value. And look, the surge wasn't random. It was explicitly initiated and amplified by structural factors. At 9:42 in the morning Eastern Time on December 22nd, the stock triggered a limit up, limit down pause, an LULD pause. Now for listeners, that's a halt when a stock moves too fast. This mandated 5-minute halt allowed demand fueled by retail traders anticipating a squeeze to just consolidate. When trading resumed, that pent-up demand acted as a massive accelerant. It spiked the price from 50 cents to over $1 in minutes. The structure of the market created the opportunity, and retail sentiment, the YOLO psychology, provided the fuel.
That's a compelling argument about the mechanism of the spike, I'll give you that. But I come at it from a fundamentally different place. While I concede the LULD pause created momentum, I want to pull back from the minute-by-minute chart and look at the engine driving this instability, the balance sheet. The volatility is mesmerizing, yes, but it is fundamentally driven by the company's precarious standing, ensuring a long-term downward trend. The evidence isn't in the trading tape, it's in the books. The company has an existential, let's call it a solvency gap. Available liquid cash is critically low. We're estimating it's between $86,000 and maybe $170,000. This tiny cash balance is just dwarfed by their total debt of $3.5 million. To put that in real terms, for a logistics operation with $25 million in revenue, $170,000 in cash, that probably covers less than a week of fuel and payroll. Notice they got on December 15th for trading below $1. It mandates they fix the price by June of 2026. This pressure forces management to consider a reverse stock split. Combine that with the VIE structure, the variable interest entity that creates trapped cash in China, and the US-listed entity is basically guaranteed to resort to extremely dilutive equity raises. The financial reality ensures destruction of value, regardless of one day's euphoria.
Okay, let's go back to the heart of the Monday event, though. The velocity of that volume. Your argument frames it as a consequence of distress, but I maintain it's an independent force. It's driven by market structure, which simply exploits that distress.
I'm just not convinced by that. The idea that this volume is purely HFT excitement divorced from what is, let's be honest, a terminal illness for this company. I don't buy it. The extreme volume is the natural consequence of overhead supply. Who is selling 321 million shares? These spikes serve as critical liquidity events for trapped investors, the bag holders, to finally desperately exit. This guarantees that any price rally is just going to be capped by millions of shares from desperate sellers. It's exhaustion volume, not breakout volume.
Okay, that's an interesting point about the bag holders, and I'll grant you that exit liquidity certainly exists. But the mechanics governing how that volume transacts are dictated by structure, not emotion. This is where high-frequency trading and wholesalers come in. The volume is intensely fueled by the internalization of retail flow, often executed off-exchange. We have data showing an off-exchange short volume ratio of about 10.47%. This shows that wholesalers are absorbing massive amounts of retail buy pressure in dark pools. For the audience, dark pools are private exchanges. By internalizing retail buy orders there, market makers are dampening the expected price rise on the main exchange. This engineered price suppression, this divergence, is precisely what attracts the sophisticated volatility arbitrage traders. They trade that difference regardless of the fact the underlying business is only generating, $25 million in revenue? The trade is on the market structure itself.
That's a very sophisticated explanation, but it still requires a degree of corporate vulnerability to be exploitable in the first place. You're basically admitting that the market structure is profiting off the very weakness I'm describing. Do these arbitrage traders care that this manufactured divergence guarantees management will have to resort to even more desperate measures later? The trading machine just accelerates the fundamental decay.
But we're talking about two separate time horizons. The arbitrage trader in the dark pools cares about the next minute, not the next quarter. The company's impending demise is merely a catalyst. It's the low float and the high retail interest driven by the distress that makes it the perfect technical vehicle. The financial fragility is a feature, not a bug, in this scenario.
All right, let's follow that logic to its inevitable conclusion then. The NASDAQ notice, the regulatory straitjacket. If we accept the pressure to cure the sub-$1 price, we have to talk about the reverse stock split. This is where your structural argument meets the fundamental hammer of corporate solvency.
I see the reverse split as merely a technical cure for a technical problem. The threat of it is what matters to traders, not the execution itself. Short sellers know the split is artificial. It does nothing to solve the $170,000 cash problem. Their playbook is set. They will immediately short the stock once it hits, say, $5 after a 1-for-10 split, betting it instantly reverts to its true distressed value of 50 cents. This expectation creates a structured, profitable short trade. It's not a death knell. It's just a new, predictable phase in the trading cycle.
I see why you think that, focusing on the short trade. But let me give you a different perspective based on history and corporate necessity. This isn't theoretical for HXH. Management has a proven, destructive playbook. They did a 1-for-4 reverse split back in 2020. This action, when it's done under duress, is a public and devastating admission of failure. But here's the critical sequence. Given the near-zero cash, a successful reverse split will immediately be followed by toxic financing. We are talking about registered direct offerings. They sell massive blocks of shares to institutions at a deep discount, often with warrants. They need this capital desperately to address the $3.5 million in debt. These offerings flood the market with new supply, and that immediately initiates the death spiral. The RSS just serves as the precursor. It artificially elevates the price so the subsequent dilution is palatable enough for institutions to buy in.
That's an excellent historical point, but I'm focused on the forward mechanics. The market is efficient at pricing in the probability of future dilution. The participants driving Monday's volume, they are not concerned with debt covenants or future offerings. They are focused on minutes and seconds, betting on the volatility created by the ULLD pause and the hope of a quick squeeze. The RSS threat is just a future event that will reliquefy the market for a new cycle of trading.
That takes us back to the ultimate disconnect and the risk you're ignoring. The core truth is the company's financials, a thin 12 to 14% net margin operation with negligible cash.
The sheer absurdity is that the market cap swings in a single day driven by your 55 times float rotation often exceed the total replacement value of the company's entire fleet of 213 trucks. That disconnect is completely unsustainable. It represents unquantifiable risk, and this fundamental fragility is the precise reason the stock is being used as a speculative vehicle in the first place. The technical frenzy you describe is a spectacular symptom of the underlying terminal illness. You can't separate the illness from the fever.
See, I'm not convinced by that because the investment case is, as we've said, irrelevant to the people driving the volume. They're not buying a logistics company, they're buying variance. For the HFTs and the retail speculators, the stock is effectively a leveraged derivative based purely on momentum. Now, here is a crucial counterpoint to your terminal illness framing. The fact that the stock does generate between, say, $3.1 and $3.9 million in annual net income, while insufficient, I'll grant you, it actually provides a weak but legally defensible floor against immediate Chapter 7 bankruptcy. This minimal actual profitability prevents the stock from being a pure zero. That tiny bit of underlying scaffolding is what makes it a viable lottery ticket trade based on the hope of a short squeeze. Even with a low absolute short interest of only, 56,000 shares? The existence of a business, however ailing, is just the structure that allows the technical play to exist.
But the volatility itself is the crushing cost of that trade. The fundamental analyst sees a company that needs a 200% sustained rally just to cure a NASDAQ defect, while needing millions in capital just to avoid solvency failure. That instability is baked into the price, and every technical spike, every dark pool trade, is just borrowing future value and accelerating the need for dilution.
And every technical spike is a testament to the power of market structure to completely dominate corporate reality when the float is tight and the psychology is primed. To summarize my perspective, the hypervelocity of the stock, shown by that 55x float rotation, and the dampening effect of dark pools on Monday, it confirms that HXX operates entirely outside the boundaries of fundamental analysis. It's a structure play offering extreme variance, where the technical setup supersedes the actual operations of the Ningbo logistics business.
And my summary remains firmly rooted in financial reality. The extreme volatility is merely the speed at which the market is recognizing the company's existential solvency gap, that less than $170,000 in cash, and the regulatory straitjacket from NASDAQ. The looming corporate action, whether it's a reverse split or forced toxic dilution, is guaranteed to perpetuate the long-term trend of value destruction, making these explosive spikes just temporary relief valves for exiting shareholders.
What this discussion really shows is that the material provides robust evidence for both sides, both the structural case and the fundamental risk. The dynamics are entirely different depending on your time horizon.
It certainly reveals the inherent complexity of modern markets, where the physical reality of a modest fleet hauling frozen food can be completely eclipsed by the forces of financial engineering and speculative mania on a trading screen.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.